to know individuals and getting into individuals, their people, your unique needs, objectives, et cetera, and then really making that work, taking the economy and the markets and making it apply to your own financial plan and being part of a financial plan and helping people achieve their goals. So excited to be here today. And again, thank you for your time. As you probably can tell already, my wife reminds me regularly that I never know when to zip it. So I'm going to try to get through this efficiently and not take up too much of your time, and then would love questions along the way. But whenever I kind of think about where to start in terms of any kind of economic outlook or market outlook, I like, all right, if there's one thing to take away from what's going on, where to start, it's probably this slide. And this slide, I will keep referring back to what's going on in this slide throughout this conversation. But if there's one thing to take away from on this slide, which is just a chart of long-term interest rates, long-term yields on various government securities that I'll speak through in a second. Almost everything that's going on in financial markets today, that will be going on in financial markets for the next several quarters, that's happened over the last year or many years, relates to what this slide shows. And I'll bring up a pointer. Hopefully you can see that. You're able to see that pointer, Christian, if you could confirm for me. Beautiful. So this is a chart of interest rates, long-term interest rates, which is denoted by the blue line here. This is the yield or the interest rate on 10-year government yields, government notes, I should say, as well as short-term interest rates. The orange line is the yield on the 3-month T-bill, the 3-month Treasury bill from the US government. And these are reflective of just what interest rates have done. This chart goes back to 1982. And you can see the clear trend, as everybody is familiar with, if you've had a mortgage and been able to refinance over the past years. Interest rates in the United States have largely been doing one thing for many decades, and it's in a slow and steady decline. And this part right here, this accelerated and very steep increase in interest rates, both short-term interest rates and long-term interest rates, is at the epicenter of everything that's going on today. That rate of change, because you could look at it and say, oh, well, they've gone up, but they're still relatively low. I will say the rate of ascent, how fast interest rates have increased in the last year and a half by over 500 basis points, by over 5%, is something that this economy is not used to dealing with. And one of the reasons it's not used to dealing with it is because if you look at the orange line again here, this starts at 2009. 10 of the last 14 years, this orange line again is short-term interest rates. The cost of money has almost been free. It's been extremely low interest rates for over 10 years. And that's something that the economy, investors, consumers, companies, if those interest rates start to set the cost of a loan, credit cards, mortgage rates, construction loans, you name it, investors have gotten very used to just cheap costs of capital, cheap cost of debt. And so the entire economy right now is just geared towards this low cost of debt. And so this sudden and significant increase in interest rates it's starting to work through the economy. The economy is trying to digest it, as well as investors are in different areas of the economy. But if there's one backdrop that you kind of take away from, because I'll keep referring back to this phenomenon regularly throughout the presentation, it is at the heart of what's driving so many things going on today, right now, in both of the economy as well as the markets. And that with that as a backdrop, going into kind of I always like to start at, all right, what's gone on in the first quarter, January, February, March of 2023? What's happened as a way to inform like maybe where we're headed and what might we expect going forward? Two significant things I think happened in the first quarter, and I'll refer you over here to this circle right here. One thing, coming into the beginning of 2023, the expectation for economic growth and the expectation for inflation in the United States coming into the year were actually that economic growth was going to slow significantly and actually, in fact, be barely positive, maybe be just a little bit above 0%. And with that, the expectation that inflation was going to slow significantly as well, from a rate of 8 or 9% that everybody's seen in the headlines earlier last year to potentially a rate of 3 or 4% as we come into 2023. One big thing that's, I think, surprised a lot of investors and been better than expected is the rate of economic growth in both the United States as well as the world is denoted in this picture right here, circled in the red circle. This is a chart of an index that we track regularly, which is economic surprises. So if you think the an expectation for economic growth might be, I think economic growth is going to be 1%. And when it's actually reported, it comes out at 2%. We would refer to that as a 1% positive in positive surprise, economic surprise. So when things are better than expected, that's usually good for markets, good for the economy. When things are worse than expected, we usually are indicating that, okay, things might be getting worse from here, all in relation to expectations. And as you can see, all the lines around the world are above zero. So throughout the first quarter, economic growth was much better than expected. And that was a surprise to both investors, to markets, in terms of what those base expectations were coming into the year. As terms of a driver of what was driving why things were better than expected, you can see on this chart here, this chart lays out essentially the Purchasing Managers Index is something that we track regularly, and it reflects the general level of activity in two areas of the economy. The orange line refers to what was going on in the manufacturing sector of the economy, and the blue chart, the blue line, refers to what was going on in the services part of our economy. And the two are significant contributors to economic growth. And then this dotted red line basically is if the line is above that dotted red line, it's expanding. So things are growing in that part of the economy. And if it's below it, it's contracting, it's receding, it's slowing down. And so we'll track this regularly to see, all right, are things getting better or worse? Are things growing faster or slower? And so you can see in the terms of the manufacturing sector of the economy, clearly slowing down from going back to 2022. It has been on a slow trend well into 2023. And right now is actually, in fact, contractionary territory. And we'll talk about the R word in a second, recession and whatnot, and what that means. But manufacturing clearly slowing down. What surprised a lot of people, what surprised to the upside, and what was driving those positive economic surprises was the services sector. Especially, you can see almost at the end of the year, the services sector almost went on a tear once again, always through the quarter. And throughout all of the first quarter, as you can see here, it's remained in expansionary territory. What's included in the services sector of the economy, if you think about travel and leisure, so there's still huge demand for going on vacation, for plane travel, for hotels, leisure. There's still huge demand for healthcare services. There's still huge demand for financial services. All those things go into the services portion of the economy, and those are still in high demand. The other thing that's driving that better than expected growth in the services part of the economy so far this year, the demand for labor within that. So not only the demand for labor, but how much people are being paid. Wages within those services sector of the economy are accelerating very rapidly because, as you've probably seen in the headlines, there's labor shortages. Companies can't hire enough workers. There's job openings that they can't fill. A majority of those openings and a majority of that labor demand is happening in the services part of the economy. If you've gone to a restaurant, they're short-staffed. If you've gone to a hotel, they're short-staffed. If you've gone to choose a store in the local St. Louis area or Missouri area, they're usually short-staffed. Those services sector of the economy are just in high demand. And that's what drove that better than expected economic growth through the first quarter. The impact that it had is inflation remained more persistent. Inflation stayed higher than people thought it was going to throughout the first quarter. And that's had implications for what the Federal Reserve is going to do around interest rates. In fact, we've already had 2 interest rate hikes going in from Q4 into Q1. We're expecting another interest rate hike from the Federal Reserve on May 1st of about 25 basis points. But coming into the year, the expectations were that inflation was going to slow. And actually with that, we potentially would even start to see interest rate cuts by the first half of 2023. All those expectations, because things have been better than expected, especially in that services sector, all those things have been kind of turned upside down, and that's led to some interesting market developments, but also market activities. The biggest one being this, what's gone on in the banking sector. So this is a chart of the regional bank index from the S&P 500. So all the smaller regional banks all combined. And this, what you can see here, probably no surprise to anybody that's seen in the headlines, things that happened with Silicon Valley Bank, things that happened with the First Republic under pressure, Signature Bank. A lot of the smaller regional banks came under significant pressure, especially after what happened with Silicon Valley Bank earlier about midway through March. That's what's deflected here. That really was a result of what's gone on with interest rates and that significant increase in interest rates that we've seen in the last year and a half. And in relation to that, some of the deposit flight that we saw somewhat out of the regional banks that are smaller, more interest rate sensitive areas of not only the banking sector, but of the economy. Those are 2 significant events that drove a lot of the activity in the first quarter of 2023. And if you start to go through here, this chart just is a table of how different asset classes performed through, this is actually just a little bit into April, but captures much of the activity for the first quarter of 2023. And yep, go ahead. Yes, sir.
Banking slide on the last one, if you don't mind going back to
Absolutely.
that. Obviously, I think most people have heard the story of Silicon Valley Bank and other ones. How much of there's the interest rate component that's true of every bank. There were things that were somewhat unique to Silicon Valley Bank. So if you've got your money at a regional bank today, or if you're an investor in, say, the banking sector, how should you be gauging the risks going forward now, post some of the Fed's actions? How should you be thinking about that now?
It's a fantastic question. What's been fantastic, and you'll see things have clearly stabilized in the regional banking sector as well as the banking sector overall. And I'll start with your point that you make around the very specific business model that some of the banks that came into under stress had is very specific to those banks, Silicon Valley Bank in particular, and even Signature Bank. They were very, very exposed, very, very concentrated in the tech sector as a business. So they had significant amount of deposits, not even from individuals. They were holding deposits of technology related companies. So a lot of startup companies, so out in San Francisco, Silicon Valley, hence Silicon Valley Bank, a lot of the startup companies and tech startups, biotech startups, they were burning through cash in just because how their business model works. They would put all of their working capital on deposit with Silicon Valley Bank because of the rates of interest they could start to earn and the loans that they could take out against those deposits from Silicon Valley Bank. It was a relatively risky business model, if you will. And then as interest rates started to change, as interest rates increased, if you go back to that very first slide, they went up so much so fast. Those same companies now, they were able to get cheap loans because money was free for so long. Remember that flat part of the line. Money was almost free for so long, all of a sudden became very expensive. They were not able to get cheap financing in the same amount of capacity as they were previously. And they had to then withdraw on the deposits that they held at Silicon Valley Bank and other similar banks. And because Silicon Valley Bank at that pace was so concentrated in how many tech and biotech companies of a similar profile they had, they came under stress, very unique to what they did. But what's been good is very few other banks have that concentration. It was a very unique business model to Silicon Valley Bank, to some extent First Republic. But what's been good is, as a result of this stabilization, Federal Reserve, the Treasury, and the FDIC, and even really the government, not only here, but also in Europe, when you look at Credit Suisse and other types of banks, they've come and they've essentially backstopped and said, listen, there's plenty of liquidity to be had. What's been good is all the banks, as they looked at the stress tests underneath, all the banks are well capitalized. Even a majority, if not almost all the regional banks are well capitalized in terms of going under. They backstop them with liquidity. And so as a result of that, you've seen significant stabilization in the banking sector in a very short amount of time. The other thing I will add to that as it relates to the banking sector, if you remember, I'll go back to this slide for 1 second. You'll notice the short-term interest rates are above the long-term interest rates. And that's what we refer to as an inverted yield curve. Usually, short-term interest rates would be lower than long-term interest rates. The business model that banks generate profits on rely on, I'll take in deposits from the average person. You put your money in a deposit with a bank. They hold that bank in deposit. They hold that deposit in their bank, in their vault, so to speak, and they'll lend out a fraction of that deposit in the form of loans. So loans for a bank are assets. And normally they're earning profits based off of the short term versus the long term being higher than the short term. So they're earning those interest rates. Banking profits have been lower than expected because in an inverted yield curve in the short term, they can't generate the same amount of profit. So all those things came into effect on a short amount of time to generate this kind of stress, the near-term stress in the regional banking sector in particular. But now it's been stabilized given the backstop that the government's come in.
Another question I hear a lot about this specific thing, and I'll give kind of a short answer, but feel free to add to it. But a lot of people say, as soon as you hear banking, people think Lehman Brothers and Bear Stearns and those sorts of things. And so the question often is this 2008? What's the same? What's different? And I think a big part of it is the difference between the issues banks having being credit related versus interest rate risk related. So in 2008, so much of it was what is on these banks' balance sheets. Are there these subprime mortgages. Whereas this time around, it's really not a credit risk problem. And that those are the kind of problems that keep you up at night if they're credit risk problems. This is an interest rate one. So we've talked before about if you own a treasury bond and you buy it for 100 and it's a 3% bond, let's say interest rates go to 5%, that treasury bond is going to be trading at less than 100. But if you hold it to maturity, there's not risk of default. That's not what we're worried about. What creates a problem, though, is if all of a sudden there's a game of musical chairs and people are pulling their deposits from one bank and putting them in another one because they're not sure if their deposits are safe at that bank. All of a sudden, that bank has liquidity issues. They're forced to sell things at losses. So if the Fed can step in and stabilize, that game, it's not a credit risk problem per se, like 2008. But that's one of the things I take comfort in. But anything else to add to that, Steve?
No, 100%. Actually, you hit the nail on the head, and probably there's a theme that will come out of this, the things that we'll look at. But as somebody who I was actually on the Lehman Brothers earnings call the Friday before they declared bankruptcy, listened to the earnings call, listened to Aaron Callahan, who was their CFO at the time. Not only that, but also closely aware of Bear Stearns. Having lived through that and experienced that, I can tell you the issues being seen in the banking system today, or that had been being seen, are completely different. As to your point, those were all credit crisis related. So Lehman Brothers in particular, Bear Stearns, several other banks at that point in time had gotten way overexposed to specific areas of credit. At that point in time, it was subprime mortgages, lower rated mortgages in the housing sector. And as the housing sector came under pressure, it all revolved around itself and then spread in the system. What's been taking place, and to one of the reasons why banks today are so well capitalized meaning just you hold a certain amount of reserves on your balance sheet, backstopping loans that you've made. One of the reasons that banks are so well capitalized today is in reaction to what happened in 2008, 2009, the government and regulatory restrictions that have been placed on banks. They now have separated out systematically important financial institutions, which they isolate out the Banks of America, et cetera, larger financial institutions, but even regional banks and others have been forced to hold much more collateral, much more reserves in balance sheet against loans they've made. And they've now separated out commercial banks from investment banks. All those types of regulatory things have happened since 2008, 2009 to make sure that that same amount of credit risk can't be taken by banks.
Awesome.
But it's made for an interesting dynamic for sure in the first quarter. I'll go back to this. I'll go through this table. I'll point out a couple of things that I think speak to, again, that backdrop of the parts of the economy and the parts of the markets that are reacting right now are again reacting to the interest rate changes that have taken place relatively near term. And I love to compare what's going on near term. So these are the year-to-date returns of these various asset classes. And then, but what's going on longer term, even just in the last 1 year. And what's amazing is sometimes you can see very, very different picture. If you just look at the S&P 500, right, tend to be large cap, stable, large cap companies in the United States, 7.8% return year to date, but in the last year, still down 6%. So they're still recovering from what happened in relation to interest rates increases throughout 2022. One other thing I'll point out, this next row, this is one thing that we look at a lot. The EW stands for equal weight. So people may or may not be aware. So the S&P 500 is a market capitalization weighted index. And actually right now, if you looked at the S&P 500, the top 7 companies, the highest weighted companies in the S&P 500, the bigger company you are, the more weight you carry in that index. The top 7 companies, the S&P 500, constitute almost 25% of the index. So what those 7 companies do determines a lot of what's going on in the index. But if this equal weighted index equal weights every single company. So a lot of times I'll look at these two in relation to each other to say, hey, wow, 7.8% return on the S&P 500, but the equally weighted index was up much, much smaller. And that's probably more reflective of what the general equity market is doing. And then if you look down below to the NASDAQ, which tends to be more technology weighted, that's had a significant increase year to date. But yet on the 1 year, still down almost 9%. Some of the most interest rate sensitive parts of the economy and the markets are these technology related companies. Think of an Amazon, think of a Google, think of a Facebook or Meta as it's renowned for now, even Microsoft. Those are heavily related, heavy reactionary to interest rates. And so in 2022, when interest rates came up a lot, those companies took it on the chin, if you will. But now, remember, coming into 2023, expectations were that inflation's going to get better, inflation's going to be lower, interest rates are going to start to come down. That's been a big part of what's driven this recovery, so to speak, in those interest rate sensitive names in the economy. But right now, we don't think going forward that will continue. We'll talk a little bit about why, but that's one area that's been interesting to watch, is just what's going on in the general economy, kind of that equally weighted idea. And then some other parts, small cap stocks. This is the Russell 2000. These are small capitalization companies. Again, look more like that 1 to 2%, as there's kind of a slog going forward as the economy digests the higher interest rates. I know there's probably a couple of people that are fans of gold in the audience. Gold's been a really interesting story for us to follow. I follow gold pretty closely. If you look at year to date, up almost 10%, but 1 year ago, just up a little over 1%. Gold I look at as a proxy for real interest rates in the economy. So a lot of times, if the expectation or investors are getting concerned that the Fed is falling behind the curve, that inflation is going to start to get carried away and interest rates aren't being risen fast enough, gold will tend to do well. And that's actually what's happened this year. In addition to the stresses in the banking system, that's usually those kinds of turbulent times are when gold tends to do well. But in the last 1 year, in 2022, actually gold did not perform very well, because interest rates were being raised so fast that they were able to, that the idea was, oh, they're raising interest rates, they're going to contain inflation. That tends to be when gold does not perform very well. And that's that stark dichotomy between year to date up 10%, but in the last year, on 1 year, just up 1%. And that actually relates to the dollar as well. The dollar down year to date, that's something that we think will continue, given not only some of the fiscal issues we'll talk about, but even some of the relative interest rates in other parts of the world that we'll talk about too. Let me stop there. Now you're probably starting to see why my wife says I never know when to just zip it. I just keep going. So let me stop and see if there's any questions or thoughts from you, Christian, or anybody else.
I don't have anything. I'm still working out the mute button. So if you do have a question and I have you muted somehow and you're not able to get unmuted, you can click on that chat button in the bottom and mention that you have a question, and I'll make sure you get unmuted. So. Steve, I think I did it again. I managed to mute you for a second time on a call. So you may need to unmute again. Steve, can you hear me? I think I muted you again.
How about now?
Sorry for setting the record for probably the most times the host has muted you.
No, it's all good. It's all good. It's like improv. It's like Saturday Night Live. This is like, hey, we're going through this live. This is good stuff, right? And if nothing else, hopefully it's entertaining for all the participants to see us work through it. So
that's great.
It's all good. But so if that is a question, kind of what happened in the first quarter, I'd like to go now to, all right, what's ahead? Where are we headed from here? I'll say kind of a spoiler alert. If you think about, again, that very first chart, kind of digesting these higher interest rates and how fast interest rates have moved up, how that reverberates through the economy, through almost every sector. Think about rates on credit cards, rates on mortgages, rates on car loans, you name it, both car loans, personal loans, construction loans. The economy needs to digest that. And so right now, for the foreseeable future, for the next several quarters, it's going to be kind of a slog. And it's you'll see as we go through things, it's a balance between, again, the R word will come up. We'll talk about recession or not. The good news, I will say, we don't see anything right now that it falling off a cliff. We don't think anything is in danger of getting much worse than expected. But at the same time, as we go through things, you'll see there's not a lot of huge positive catalysts that aren't seen at this point in time. So it's going to be a period where we digest higher interest rates and we establish a new trends going forward and kind of look for opportunities. But let me talk through why that's the case. I start with this framework. This is just a chart of, this is where I'll focus your attention for right now. This is in terms of the drivers of economic growth in the United States, I like to break it down into these components. And this really is how the economy breaks down in a given year. Almost 70% of our economic growth is generated by just consumer spending, consumer activity. Around 17% is generated by government spending. Around another 17% if you combine housing and just think of private space, so corporate profits, capital expenditures by companies, things of that nature, added together with housing, it's about equal part to government spending. And then if we're importing or exporting more or less, that tends to weigh. If we're importing more than we're exporting, that tends to be a drag on our economic growth. Right now, we're importing a lot more than we are exporting. So it's been a kind of a negative drag. If that were to reverse, it becomes a positive. But I try to go through the economy in this kind of framework and think about, okay, are things getting better or worse? The long-term trend for economic growth, real ex-inflation, so real economic growth is over on this chart. It's about 2%. So to put in context, coming out of the pandemic, we were growing at around 4 or 5%. We were growing very fast. Right now, our fourth quarter real GDP was reported at 2.6%. We'll get the first quarter GDP report next week, actually, on Friday. It's expected to be around 2%, maybe 2.2%. So in the concept of like, are we in recession? Recession's a normal part of the economic cycle. And so its growth is receding. So we've slowed down from 3, 4, 5% growth at some points of time towards more our longer trend in order to get inflation under control. When things are growing too fast, that's usually when inflation starts to ramp up. And so the implications of that and how we're getting that economy to slow down again is on, actually, let me just skip forward one chart and then I'll skip back, is again, this is the yield curve that we looked at before. You can see, so this is, this lower line right here represents the yield curve on December 31st, 2021. This blue line right here represents the yield curve, and this is just the interest rates on different parts of the treasury curve. So whether it's a 3-month treasury, a 5-year, 10-year, 30-year, these are the interest rates that equate to those different points in time. Again, here is December 31st, 2021. 2 years, almost a little over 2 years later, so at the end of February, this is where interest rates were. So you can see there's been, again, a huge shift up in where interest rates were, but more importantly, short-term interest rates are much higher than long-term interest rates. And that's putting a massive brake on the economy. That's why growth is slowing, because it impacts all areas of the economy. The other thing you can also see from this gray shaded region is the entire range of where interest rates have been in the last 10 years. So you can see we're really in the short end of the curve, actually. We're actually near the top of the highest interest rates we've seen almost 10 years. Again, that's all things that the economy needs to digest, and why there's probably talk of slowdown, but also talk of recession. And with the R word recession coming up, let me go through this. Recession is just, again, a normal part of the economic cycle. Things are slowing down, and probably the question you may get, or questions that there's a big debate right now, is are we already in recession? Did we have a recession? Are we going into recession? I try to look at it as objectively as possible. And so recessions by themselves are actually who declares if we're in recession. It's actually an organization known as the National Bureau of Economic Research. That is the official organization that will declare if the US has had or is entering or is in a recession. They look at 6 very distinct variables in order to determine if we are going into or in a recession. The 6 variables are at the bottom of this chart. And so as you can see, this is as of the end of February going into March. 4 of them are still positive. And the big determinants, if you look at these 6 variables, because of real personal income, non-farm payroll, that's employment, household surveys of employment. Do people feel good about whether they can get a job, have a job, keep their job? Consumer spending, remember how important that is to the economy. Wholesale and resale sales, are people spending and buying? What are the activity they're actually doing? And lastly, industrial production. Right now, 4 of those 6 are still strongly positive. Employment's been strong. The other thing is, up top in this side, you'll see almost a heat map of each of these variables. You can see clearly when all 6 variables are clearly negative, as it was going into the pandemic, that is clearly a recession. But if you look at this heat chart going across through time, and even if you were to extend this out even till right now into February and March, these variables are all still growing. So it's hard to say, especially with economic growth that's been 2.5%, and will probably be 2% this year in Q1, that we have been in recession or have experienced a recession since the pandemic. Going forward, these are the things we'll continue to watch, and we're definitely slowing down, but hard to say that we've been into, I would say we have not had a recession yet today, largely because of the employment and the consumer spending activity that we're continuing to see. But having said that, again, this brake that's acting as the economy, how that flows through to the different parts of the economy. If you think about consumer spending and its importance to the economy, how consumers feel, how the average person feels, how you and I feel usually impacts our spending. One of the things that concerns us, but is getting better, consumer sentiment. This is a gauge. This looks at consumer sentiment back to almost 1947. You can see consumer sentiment most recently has come way off, but has stabilized. And you can see, so this is kind of coming out of the global financial crisis, and most recently, here's the pandemic. Sentiment kind of deteriorated post-pandemic. The war in Ukraine, inflation concerns, you can kind of see what would cause sentiment to start to roll over, but it's recently stabilized. The interesting thing about this chart is that usually consumer spending, as consumer sentiment's rolling over, consumer spending usually slows significantly. And that's usually what causes, or one of the determinants that goes into recession. What's been interesting is throughout this entire period, consumer spending has actually stayed relatively strong and actually been much stronger than expected. One of the reasons for that, I think, speaks to this slide, which is unemployment. Unemployment today is 3.5%. And you can see here, the long-term average rate of unemployment in the last 50 years in the United States is 6.2%. So we're almost half of what the long-term average unemployment rate is. The unemployment rate in this chart is actually the dark gray line. So you can see where it spiked to in the recession, in the pandemic. This is where we are today, 3.5%, up a bit from 3.4%, but that is giving a lot. That's probably the reason why consumer sentiment is stabilized, but also the reason why consumer spending stayed so robust as consumer sentiment started to deteriorate. People had jobs, their wages were increasing. The other line on this chart is actually wage growth, which is denoted by the blue line. Wage growth is well above its average, long-term average of 4%. So people have jobs, they're employed, and they're seeing wage increases of 4 or 5%, in some cases 6%. What's important to realize is a year ago, inflation was running at 7 or 8%. So it felt like I was getting a 4 or 5% raise, but still not as high as inflation. Inflation is now running back 4 or 5% most recently. So now wages are in line with inflation. So consumer spending is starting to, again, stabilize. Consumer sentiment starting to stabilize, and employment's still very tight. But that's one of the things that we look at as it's still a strong support for the economy not to be in recession. And then how that flows through into the average consumer. The headwind that we see, this is just a chart of kind of the average consumer balance sheet, if you will. Most people, if you look over here, their homes are a big part of their asset base. Maybe they have pensions and whatnot. But most importantly, this is what we've been tracking, this chart right here down in the lower right-hand corner. The consumer, this blue shaded region right here represents excess savings by the average person. And you can see it exploded during the pandemic, if you remember. So everything shut down. And because of the fiscal support the government was providing, people were able to rack up a lot of savings. But as we started to reopen the economy, savings are starting to be spent down pretty quickly. The other thing we're watching closely on this chart, this blue line right here, is the personal savings rate of the average person. Are they saving more than they're spending? So it's since the pandemic started to end, savings rates have come way down. They're starting to improve a little bit, but what this chart tells us is actually inflation and other things are starting to impact and be a headwind to consumer spending going forward. People are starting to not be able to save as much. They're starting to spend more. And the other thing that we're starting to see is that consumer credit is starting to increase. So people are starting to go to credit cards in order to maintain their level of spending. Why that becomes somewhat of a concern or something that we're watching closely is the availability of credit is starting to get tougher. So this is a chart of two things. The blue line represents a survey by the Federal Board of Reserve Bank of New York that we track regularly. The blue line represents a survey saying, is it easier to get credit? And the orange line, is it more difficult to get credit? The orange line represents the survey saying, is it easier to get credit? And you can see the two are clearly diverging, really since the pandemic, but essentially even since kind of 21, 22. So consumers are now saying, hey, I need to start to use the credit cards a little bit in order to maintain my spending because costs of everything are up and wages are trying to keep up. I'm able to save a little bit less, but it's getting more difficult to get credit. It's not getting as easy. And the other thing, if you think back to that interest rates, the cost of credit, if you looked at the interest rate on your credit card recently, the cost of credit, the cost of servicing that debt is going up. So it's starting to impact the ability for consumers to spend more going forward. And that's somewhat of a headwind for us, where when we look at it, it's like, that's not going to be probably a big catalyst for economic growth going forward. It's kind of going to be a muddle through, but not a big better than expected, so to speak. And that's kind of the state of the consumer. The other thing that the consumer we watch regularly is, are people falling behind in their debt service? Are people falling behind on various credit cards, auto loans, and whatnot? This is something, again, that we track regularly. This is the delinquency trends on various kinds of loans. Delinquency being if somebody has not made a payment on their debt on their loan in more than 90 days, it goes delinquent. And so the blue line is auto loans, the orange line is credit cards, and the gray line is primary mortgages. And so you can see there's been a steady, since the crisis right here in 2007, 2008, delinquency rates have been coming down significantly. The cost of debt's been coming down. Interest rates have been declining. But we're watching this little inflection point pretty closely as people are starting to come under stress a little bit. In particular, auto loans for us have really started to accelerate. Still off a low base, but it's just a headwind going forward. In terms of primary mortgages starting to become a headwind, we'll look at the housing market, which is on this slide. Housing prices are up significantly. So the demand for housing has been through the roof, inventory is down, but the affordability because of mortgage rates, we started to see a lot of people lock in mortgage rates under 3% when interest rates were so low, or mortgage rates this past week were reported at 6.5%. So as a result, this is the affordability index that we track. Affordability of housing's come way off. And again, that all starts to impact people's ability to spend. So now I can't take equity out of my home, or I can't refinance my mortgage, because if I have a mortgage at 3% and I refinance, it's not going to cost me 6%. So that all starts to just become a headwind to consumer spending going forward in terms of that part of the economy. Nothing disastrous, but again, it's just a slog through. Let me take a pause and see if there's any questions so far. Anything, Christian, that you had on your mind in terms of what we've gone through so far?
Loosely related to what you were just talking about. So talking about all the different ways that interest rates affect, various sectors and parts of the economy. This is maybe a longer term question, but as you think about the government debt, higher debt, when the average bond on the government's balance sheet is 2% or 1%, it's a little different than say if it's 5% or 6%. So, I mean, specifically, do higher interest rates, does that make the big government deficit more unsustainable? And maybe more generally, just do you think the deficit is a concern? Is it a big factor for financial markets? How should we be thinking about that?
Yep. I'm gonna skip forward a bunch because I think I have there's two slides that I think speak to this, because it is something that is becoming a bigger focus. So this is a picture of the Federal Reserve's balance sheet. So think of this as kind of the government's balance sheet, for lack of a better term. And so you can see just a clear trend in the balance sheet is getting bigger. That means they're taking on more debt. Their balance sheet is treasury bills that they've taken on. So not only coming out of the crisis, did they buy a lot of debt onto their balance sheet in order to maintain low interest rates? Not only treasuries, but mortgage-backed securities. That's what MBS stands for here. And then you can see in the pandemic, another huge step function up in terms of the amount of debt that they had to take onto their balance sheet. And at that point in time, it was a necessary thing to do to make sure that the economy and the average person was able to make it through the pandemic. But how that's changing now speaks to this part here. The trend is clearly peaked. And now we're in a period where the Federal Reserve, the balance sheet is starting to shrink. And so that will impact things going forward in this way. This is essentially the government's balance sheet. You can see this refers to, or this looks at to your point, the budget surplus or deficit. So right now you can see we've spiked, the deficit spiked, and it's kind of climbing. It came off, but it's climbing up in this chart right here. But we're running almost, a deficit of 6 to 8% of GDP. The trend is such that it will continue. So that is a headwind. And why that's a headwind, especially down below, it connects with this is our net debt as a percentage of GDP. It's close to 100% of our GDP. So we're almost have as much debt as we do GDP. Why that matters now and why this becomes a headwind, if you think back to that 17% of economic growth is government spending, this becomes a big headwind and government spending shrinks. And a big part of the reason it shrinks, it kind of a crowding out, if you will, because the interest on debt is going up so much, the government has to pay the interest on its own debt. So now that interest rate has gone up significantly. If you remember back to that first slide, now they don't have as much excess room for fiscal support to issue any kind of other government stimulus. That's what we refer to as a crowding out effect. If your cost of debt, so to speak, or the debt service that you have to pay goes up, you have less money to do other things with. The same thing is happening for the government here. And so that does become a headwind. This over here outlines essentially the government's budget. This is right from the Congressional Budget Office. This is basically what the government spending is broken down into: Medicare, Social Security, defense spending, et cetera. And then here are the sources of income. The big one being income taxes, right? So about 2.6 trillion on a given year. Social insurance, Social Security, the premiums that companies and individuals pay, that's what's coming in here. And then corporate taxes, and then other various forms of income. In order to make up the government spending with what we have to borrow. And that's where the treasury is, and that's where the government's issuing treasury bonds in order to help finance that borrowing. And that's what's driving the deficit. This is where we run headlong into the debt ceiling. And that's probably going to become the next big focus item in the next coming weeks. In fact, Speaker of the House, Kevin McCarthy, this week presenting a proposal to raise the debt ceiling by about $1.5 trillion with proposed spending cuts. So it will start to become a focus and probably create some volatility in the near term. The big thing that related to the debt ceiling right now that we're starting to get a glimpse of is, so far, if you look at this component of of sources of financing for the government, tax receipts are running about 3% lower this year than they were last year. Now, still more to come in, but that will have somewhat of an impact as to when the debt ceiling X date, which is technically when the government runs out of money, will come. Originally, we were thinking it was potentially September. If tax receipts continue to run in slightly below what they were a year ago, right now, again, about 3% below, could pick up. We think that X date probably bumps closer into July, August timeframe. So you still have time, but we think one of the reasons it will be a slog and we'll probably start to see some more volatility in headlines is that from now until that July, August timeframe, you'll start to see a lot of debate, a lot of political wrangling around raising the debt ceiling. Our base case, as we've talked about, and I've talked about with anybody else, a lot of other investors and people, like, okay, well, are they going to raise it? Are we going to default? The expectation, I think, and the consensus is that Janet Yellen and Jerome Powell have significant amounts of credibility with Congress overall, and that Janet Yellen in particular, their credibility as just economists and the Federal Reserve chairman, they have clearly sent a message of this needs to go well beyond politics. We need to raise the debt ceiling because a default on U.S. debt, the implications that a default on U.S. debt would have are literally unprecedented, because so much, pretty much every financial instrument on the planet is set off of U.S. debt. So now you've become unanchored. So that message has clearly been sent. So our expectation is that they won't, but like what we're seeing in a lot of Washington, D.C., it will come down to the last minute, but they'll either suspend it or they'll raise it for a year, but it will come down to the last wire. So definitely expect volatility around that as people get concerned, et cetera. But we don't think, our expectation is that they will raise the debt ceiling, come to some sort of agreement with spending on the other side, but that will move past it. And we've seen this before. In 2011, when the U.S. went from a AAA rated credit to AA rated, we saw that same kind of volatility, but they eventually funded the government. So, but expect definitely this is how the government finances play into markets, but also play into the economic growth. One last area I'll hit on before kind of wrapping this up into a portfolio. This is the other big one that I think we're watching closely, is just corporate earnings. So if you think about that private investment part of the economy, what corporate earnings, what they're spending on, right now we're in earnings season. So we've seen even today, I think Tesla reported, And there's a trend that we're starting to see in the corporate earnings season so far in the first quarter. This is a chart of earnings of the S&P 500 going back to 2001. And what I want to point out, what's really important for this chart, the different shades of each bar. So take 2021, for instance. This gray bar, this is where each shade represents a source of earnings growth. So how are earnings? Are they growing or are they shrinking? The gray bars represent margin or profits. So if a company became more profitable, their margins went up, that's a source of earnings growth. That's represented positively by the gray bar. If their sales went up, if they had more sales from one year to the next, that's represented by the green color. And then last but not least, if they're buying back shares, you might hear in the headlines share buyback, that reduces the number of shares outstanding. That's also a source of earnings growth. That's represented by blue. So you can see in 2021, and actually throughout since 2001, a big source of earnings growth has come from margin expansion. So the cost of everything for companies have been going down. The cost of labor had been going down. We were manufacturing a lot of things overseas and bringing them in cheap. The cost of debt was going down, and so their margins were getting bigger and bigger. But what you can see here, if there is one area of the economy that is in recession right now, it's earnings and corporate earnings recession. And that's simply because earnings are declining. And a big reason they're declining is the cost of everything is going up. So their input costs are going up, their cost of labor is going up, and their cost of debt's going up. And that compares to their long-term average, which is on this page. This is one of my favorite charts. This just looks at corporate profits in the entire United States against our gross domestic product. So almost, if you think about the net profits of corporate America divided by the sales of the United States in terms of revenue as GDP, that's what's represented by this blue line. And it represents kind of the profit margin of corporate America. The long-term average profit margin of corporate America going back to 1947 has been about 10%. So you can see it kind of undulates. Since about 2001, since the tech bust, when interest rates really started to decline, corporate America has been earning profits above average for the better part of 20 or 25 years. And you can see they're starting to decline. We think they'll probably continue to decline to about their long-term average. Maybe they undershoot a little bit, but right now they're at about 10.4. So they're approaching that long-term average, but that becomes a headwind to earnings growth and another source of overall economic growth that right now just becomes something to slog through. But how all this translates into whether other potential areas of expansion, other sources of growth from corporate America, there's two things we're looking at: capital expenditure and just our businesses expanding. These are two surveys that we pay a lot of attention to. The blue line is from small businesses. So they'll go out and ask small businesses, are you planning to expand, hire staff, et cetera? And as you can see, it's been a clearly decline, especially most recently for small businesses, given how hard it has been to hire staff for small businesses. This orange line represents much larger businesses. The Chicago Federal Reserve will ask businesses if they're planning on spending on capital expenditure. So both these are in decline just because of the interest rate sensitivity. Everything costs more. So that becomes, again, another headwind. But interestingly enough, what we think as things stabilize, as growth starts to slow, as inflation comes under control, and in particular, as unemployment starts to increase, one of the positive things we see happening is in the small cap space, small companies, they'll start to be able to expand their businesses and they'll be able to start to hire staff. That could potentially be one area of opportunity that we're starting to position for going forward in portfolios. The other areas that I'll speak in terms of how it relates into overall portfolios and how everything we've been talking about relates to, again, the financial plan. This is probably the biggest thing that I know Christian, we've talked about and we're talking to clients about, and I think people should be aware about as it relates to their own financial plan. Today, the interest rates that you can earn on the fixed income portion of your portfolio, and that's what's denoted here. So whether it be US Treasuries, municipal bonds, investment grade corporate bonds, this blue triangle represents the yield that you can earn on that debt today. So you can, on an investment grade corporate bond, you can earn almost 5.5% by buying an investment grade corporate bond, almost 4.5% from a Treasury, 6% on a municipal bond. That's a taxable equivalent yield too. If you think back to 3 or 4 years ago, these were almost at zero. And so for somebody, a retiree who said, hey, I need to make 5 or 6% on my portfolio in order to, maybe I have a pension, maybe I have Social Security, but in addition to that, my portfolio needs to be able to throw off 5 or 6%. When the fixed income portion of the portfolio was yielding 0, you had a lot more money in stocks and like, hey, I hope these grow and I hope they throw off dividend yields. And so one of the things that we've been talking a lot about, and today the double-edged sword of interest rate increases has happened, the fixed income portion of portfolios are now yielding 4 or 5%. So, and that yield on the 4 or 5% portion of the portfolio comes with much less volatility, much less risk in a lot of ways than the equity portion of the portfolio. So we're seeing a lot of financial advisors like yourself, and as the way we position portfolios of, hey, don't look a gift horse in the mouth, so to speak. If on an investment grade corporate bond or a U.S. Treasury or a municipal bond, you can earn 4 or 5%, that's a good solid base as part of your financial plan, and then still have a risk-seeking portion of the portfolio in stocks and whatnot, conservative stocks. But now you don't have to take as much risk, and that's just part of a good financial plan. But most importantly, it's letting the financial plan lead the way and letting the investment plan follow. And that's how we, Christian, that's how we, as you know, and that's what we work together on. That's what leads the way is the financial plan. Make sure that there's mitigating as much uncertainty in that going forward. But the last area I'll hit on, I know I'm running up on time, is just, this is another big one. The US dollar that we've talked about, we think that's a weakening trend. If you think about all the fiscal deficit that we talked about in US government, we do think that the dollar continues to weaken. And as a result of that, the opportunity that exists in some of the equity markets is in outside of international stocks. If you're a US dollar investor investing in international stocks in another currency and their currencies get stronger, that actually is a positive for you. So one of the areas, while there's not a ton of, there's some areas of opportunity in the US, one of the bigger areas that we're seeing as attractively valued that have a catalyst going forward is in international stocks, especially stocks of Europe, developed countries, and even to some extent emerging market as well. But the international and emerging stocks attractively valued we see as an opportunity. I am going to stop there. Now people understand why my wife says I never know when to stop, because once I roll, I just keep going. But let me stop there, Christian. I'm happy to questions, comments, or if people are just sick of listening to me talk and they want to go start the weekend, I understand.
Well, I wanted to emphasize one thing you said and then ask you a question about something else.
Yep.
And again, anybody else that has questions, I don't know if we can trust my tech abilities to get you off. Want to put something in the chat? You can either put the question there, or if you want to just say I have a question, I can try to unmute you. So yeah, going back to the slide, I think it was maybe the previous one about those yields.
Yep.
It was, yeah, a couple back. I mean, this is a really big deal, especially for the retired client who maybe has 50% stock, 50% bond, or 60% stock, 40% bond. I mean,
absolutely.
When we were looking at financial plan, if you throw everything into a financial planning software and you calculate expected returns and that sort of thing, if you think about half of your portfolio being in bonds, that the yield is 1%, 1.5%, that's basically your expected return in bonds. Now, bonds did better than that over the last decade because rates kept going down. So like what I talked about before, if you have a 4% bond and now interest rates go down to 2%, your 4% bond is worth more, because who wouldn't want to buy a 4% bond if there's only 2% bonds out there? So that allowed bonds to actually have better returns than what their coupon was. But it still was a very difficult thing for an investor that had 50% stock, 50% bond, because your bonds are basically just there to play defense. They're not really providing much return. But this is a massive difference if you're talking about 4, 5, 6% from your bonds without needing rates to go down or anything like that. That's just the coupon. And you can even do it in high quality bonds. That's been another thing we've seen. People have to go buy junk bonds. They have to buy, bonds of companies that are very questionable, and you're taking default risk. Now you can do it buying US Treasuries. You can do it buying, very high quality company bonds. So that's been really exciting. And it'd be great for us to have a crystal ball and to say the US stock market's just going to go up and to the right from here. But in many ways, we don't need it to still have respectable returns in portfolios because of how the fixed income side has changed. So that's one encouragement. I wish it didn't happen so fast, because when bonds go as quickly
well
as
said.
That's a lot of pain, and we all felt that pain the last 18 months.
On that point, one really important aspect that I've been talking to a lot of clients about, what happened in 2022. So it's okay, yeah, but what if interest rates go up again? I lost, my bonds were down 10% in 2022 because interest rates. What's very important to understand, and you hit on it, Christian, I think for everybody, is when interest rates go up for a bond, if that bond is yielding almost zero, its sensitivity to interest rates going up is significant. And so bonds were yielding literally almost zero going into 2022, and we had a significant increase in interest rates. That combination was what drove bond values down. But believe it or not, the difference a year makes is significant, because when bonds yield zero, there's no cushion to the bond. There's no buffer for the bond to absorb the interest rate increase. Because bonds today are yielding 4 or 5%, there's a huge buffer in the event that interest rates were to continue to go up. And in the event that interest rates continue to go up, today, looking forward, we think there's maybe 1, maybe 2 more interest rate hikes left. We're much closer to the end of interest rate increases than we were at the beginning of 2022. We hadn't even started yet. And so they had all that in front of us. But today, looking forward, we're much closer to the end than we are the beginning. And there's a much bigger buffer in their bond portfolio today to absorb those. So buying a bond today with a yield of 4.5%, 5% is night and day difference to buying a bond at 0% in 2022. I just want to make, that's something we're talking to a lot of clients about, because they become like, oh, why do my bonds go down? But it's literally, it's completely different dynamic today looking forward. And that yield to maturity concept, especially when you can hold it to maturity, is huge for a retiree on a financial plan.
Definitely. Yeah. I got a question in the chat here, and I want to get to a couple more questions, but
yeah.
As Steve said, anybody that needs to log off, go eat dinner. We won't be offended to see you disappear. We still appreciate you coming, but for anybody that wants to hang out longer, I'll ask a couple more questions. So a question we got in the chat, do you see any similarities from 2008? Do you expect a reset in the markets? Could we have been better prepared then? Steve, if you want to take it, I may add a couple things after. But.
Yeah, sure. I see a lot more similarities between today and 1998, 1999, which I also lived through as well. Only because of the tech run up that we saw in 98, 99, led by large cap growth, is reminiscent of what we have seen today over the last several years, actually the last 10 years, with being led by US large cap growth, the Amazons, the Microsoft, et cetera. But what I don't see today that I saw in 2008, 2009, and I saw in 98, 99, is the credit crisis. So now interest rates have gone up and cost of credit has gone up, but so far today, the underwriting of credit, mortgages, you name it, is much higher quality. And so one of the things that we track regularly is just the defaults. And we have not seen people, even though delinquencies are moving up just a little bit, it's still a relatively low base. It's when those things really start to accelerate that it becomes reminiscent of a credit crisis. And I think the R word invokes so much fear today, because the last time, other than the pandemic, the last time we had a recession was 2008, 2009. But within that, you had to isolate the recession, a slowdown in economic growth, from the credit crisis that ensued because of the housing bust and because of the mortgage-backed securities issues that took the concentration of risk that was being taken 2008, 2009. A lot of things have changed since then, definitely on the bank's balance sheets, as we talked about. So today, much more reminiscent of the late 90s, but I don't see a credit crisis that's emerging. But we spoke about the dollar. One of the things that I do remember starkly from 98, 99 is how it played out. As US growth slowed, as it's doing now, and it's a 50-50 coin toss with recession or not, mild recession. There's a way that we potentially slog through this, and this could be the most forecasted recession we never had. We struggle through. But what happened in 98, 99, as the US growth slowed, capital started to seek higher rates of growth. And back then, it went to emerging markets. It went to, on the back of a weakening dollar, it went to other parts of the global economy. And that's one of the things we're starting to see now. And that tends to play out for a little while. That's why I showed this slide. It tends to persist. When that starts to happen, the dollar continues to decline, usually for several years. And so that's one of the things that we're trying to play into is what is today reminiscent of good and bad, and how does it play out to take advantage of opportunities?
What's the saying about recessions that economists have predicted 7 of the last 4 recessions? Or something like
Yes.
that?
Yield curve. Yeah, that and the yield. Yeah, the yield curve and economists have predicted 7 in the last 4. Exactly.
Yeah.
I do always try to ask myself what could go right. Right. It's so easy. It's so easy, and I tend to be a worrywart, and that's my job is to worry about when the portfolios, what could go right, what could go wrong. But I do try to always ask myself, okay, what could go right? What's the good scenario that comes up? Maybe we slog through, unemployment starts to get a little bit, small cap stocks start to take off, small cap businesses start to take off. There are some really exciting things that we do start to see emerge below the surface. Like if you think about what's happening in the alternative energy space, if you think about what's happening in biotech, if you think about what's happening in infrastructure, all the development of that, infrastructure, alternative energy that are being developed today, it's starting off slow, but it is actually reminiscent of what I started to see with social media, Facebooks of the world back in 2009, 2010. It was, oh yeah, there's something new, small. It was a small effect, and then just went exponential. Same exact thing with the internet back in the mid 90s. It was small and then exponential. That has the same potential to happen in biotech, mapping of the human genome as we do cure more diseases, messenger RNA that developed out of COVID vaccines. All those things start to emerge slowly and then go exponential in the next 10 or 15 years. And that's what we want to make sure we don't lose sight of those. There's still a lot of exciting things happening that make it more optimistic. It's just this kind of near-term period where we digest higher interest rates.
And I think a point related to that too is that this has been a very telegraphed recession for a long time. And some of the drivers of it we've known about certain things have happened faster or slower, or interest rates have gone up more than we thought or whatever, inflation's come down slower. But what I think is helpful in a telegraphed recession is it creates the framework we've talked about a lot is a rolling recession. And so what can happen there is different sectors of the economy experience a recession at different times. And so a severe increase in interest rates is going to hit, say, housing very bad. That housing had a really rough year because, if you have a 2.75% mortgage, how quickly are you going to want to trade that for a 6% mortgage? Similar with the technology sector, which has really been the driver of a lot of the S&P 500 returns for the last decade. It's very reliant on borrowing at low interest rates. These are companies often that have a lot of debt, maybe don't have the most cash on their balance sheets, and they trade at a higher multiple of their earnings because it's a growth company, it's a tech company. So you're not buying it because it earns more than every other company today. You're buying it because you think 5 years from now, these companies are going to earn more than these other ones. But all of a sudden, when the cost of borrowing goes up and they've got more debt than some of these others, it's a big headwind. So tech, whether they've experienced a recession or not, it's clear they've experienced a lot more hardship than other sectors. You've seen a lot of the layoffs concentrated in Silicon Valley. So the point of all of this is whether or not we have a recession, whether or not the S&P 500 finishes the year positive or negative, there's opportunities within sectors if you're paying attention. One sector might have a horrible 2022 and have a great 2023. Tech's done that so far. The energy sector and others, there's a lot of opportunities within sectors, even if the S&P 500 itself stays at the same level or something like that. So those are all opportunities that are created. Same with globally, emerging market stocks, developed market stocks, those sorts of things. Another question we got in the chat here just is around bonds. So, with everything we've seen in interest rates so far, maybe thinking about the credit side and the interest rate side, how should we be positioning fixed income portfolios? If we were 1 to 2 interest rate hikes near the end of the curve, should we be long duration, short duration? Should we be long credit, short credit? How should we be thinking about the fixed income allocation?
Yep. So on the taxable side, one of the phenomenons that we're seeing right now is actually municipal bond spreads have actually become so compressed that when you translate municipal bond yields into a taxable equivalent yield, they are still below that of a taxable bond. So we actually have not been bringing municipal bonds into taxable accounts as much as you would think, because we're like, actually, even though they're taxable, these are still offering higher yields because municipal bond spreads have become so compressed. That's something that maybe changes sooner rather than later. But right now, the taxable equivalent yields on bonds or on munis are below that of taxable. So we're still preferring kind of treasuries. And in particular, you mentioned it, investment grade corporate bonds are in the portfolios that we continue to oversee. Investment grade corporate bonds are definitely offering one of the probably best values, I'd say, in capital markets right now, where you're starting to see yield to maturities in high grade quality bonds, triple B or better, of 5.5% in some cases, depending on how far you want to go out. And now with being much closer to the interest rate, the end of interest rate hikes, so maybe one or two more, and the buffer built in with where yield to maturities already are, we're starting to see the ability to maybe go out further in duration. And on top of that, growth potentially slowing down. So if anything, maybe interest rates start to settle in, that right now we're not as nervous to go out into kind of intermediate duration. I don't think we're ready to, with how flat the yield curve is, right? If you remember back to the very first chart, a 30-year bond is yielding almost the same as the 10-year bond. So in terms of that, there's no need to go out that far in order to capture more yield. Just stay short to intermediate duration. The short part of the curve is offering the highest yields. The other thing I will say that we're taking a lot of advantage of is wherever we can, is locking in a defined maturity. And this is great for, and I know you're a fan of these, Christian, right? The idea of a bond ladder. So whenever you can hold that bond to maturity and just ladder it out, what you're doing is mitigating the reinvestment risk, so that if interest rates do come down, you have something mature, that's fine. But okay, well, now what are we going to invest it in? So the idea you can mitigate that reinvestment risk and go out a little bit further, out 5 or 10 years, and lock in these yields of 4 or 5%. That's a huge foundation to a retirement plans portfolio. So those are the parts of the market that we're focused on right now. I will say in the high yield space, I'm still holding back on high yield. So you're seeing 8 or 9% yield to maturities in high yield corporate bonds. But what concerns me there is we're still only seeing defaults of about 2.5%. And there's a relationship between credit spreads and defaults that I kind of pay attention to. Usually spreads are about 2 times defaults. And we really haven't started to see defaults pick up yet. And I think they're going to start to increase, because there's a maturity schedule that's happening a couple of years out. So usually what I want to see is I want to start to see defaults start to increase in the high yield space, spreads blow out. That's when I want to get into high yield and actually get in at a 12 or 14% yield and ride it back down to 8 or 9 or 7. That's when I'll look at high yield. I'll look at fallen angels type strategies and distressed credit. When companies or private credit strategy can buy credit at 50% on the dollar and then ride it back up. So the riskier part of the credit curve, I'm still kind of waiting on, but watching, because I think defaults are probably going to increase. But strong cash flow generating investment grade corporate bonds, same thing on the equity side. Those are what you want to bring into the portfolio right now.
Yeah, I couldn't agree more. And anyone that's talked to me on the phone in the last month or 2 months has heard me say almost that exact same thing. And high yield it's one, people reach for high yield when interest rates are 2%. Right now, I don't feel like we have to. And the whole point about how low defaults are right now and the possibility for that increasing is enough to keep a lot of people away. So one other question that I just wanted to ask, and again, if anyone else has anything else, please put it in the chat. But just wanted to ask briefly about the US dollar. It's been something in the news a lot. So maybe several points to this question, but one, how worried should we be, or how likely is it that the US dollar loses its reserve currency status? And then additionally, what are the other alternatives, and how, let's say sometime down the road, it isn't the reserve currency. Is that catastrophic for US stock market? Is that something we need to be really worried about, or how are you thinking about that?
Mm-hmm. So I don't think even in the unlikely event that the dollar lost its reserve currency status, it would not be catastrophic. And I think that probably doesn't happen all of a sudden. If anything, it happens over time as the global economy diversifies away from the dollar strategically, not because they're trying to avoid it, But I think there's really interesting secular trends that are happening right now in global trade as a result of the pandemic. And so in terms of the reserve currency status, there actually is an alternative to the dollar as a reserve currency today. The IMF issues something called strategic drawing rights or specific drawing rights. And actually it is a hold on a basket of currencies. There's actually several reserve-oriented currencies, the dollar being the biggest one, the euro, the yen, and the British sterling. Those all have quasi-reserve currency status. The dollar is the lead. But if you were to look at the SDRs on deposit, so to speak, with the International Monetary Fund, the IMF, and the World Bank, they actually are a basket. A single SDR represents a certain weighting of those currencies. So there already is a diversification element to the idea of a reserve currency. The dollar today is the biggest weight. It's used in the most global trade. So that's what kind of has that headline reserve currency status. But actually, I think one of the things that happens is going to happen over time, and time being potentially decades. What we're seeing now from post-pandemic, global companies have said, even just economies have said, okay, I can't rely on a global supply chain anymore. I can't rely on ordering something from Shanghai and having it arrive at my doorstep 3 days later because of who knows if there's going to be another pandemic, whatever it might be. There's been a massive shift away from this idea of a single global supply chain towards what I'll say regional redundancy. And we're seeing a lot of companies, you're seeing this in the Chip and Science Act that was just issued, that was passed not too long ago. We're starting to see semiconductor fabs be built for the first time in the United States in decades, right? All the semiconductor fabs in the world were all built in Taiwan, Beijing, China, you name it. We're starting to see them built in the United States. We're starting to see manufacturing facilities be built in the United States, as well as Europe, developed Asia, all over the world. And I think what's happening is people are now saying, corporations are now saying, I need to have a regional redundancy, or maybe my main supply chain is regionally, in case anything like a pandemic happens, I can still access it. And then I have a global supply chain as a backup, or vice versa. But that capital investment that's happening will speak towards more regional specific trade. So we do expect that Europe will trade more with itself. Not to say elimination of global trade, but developed Asia, Japan, China, that region will start to trade more with itself, just because now more of the supply chain, more of the suppliers, the buyers, the purchasers are all in that region. They'll rely on more of a regional currency. The yen was supposed to be a regional Asian regional currency back in the 90s. It never really happened. We do think the renminbi potentially takes on that status in Asia. The euro potentially starts to take on more of a regional status, despite the impact of Brexit. And the dollar potentially still has a global trade, but it occupies less of a percentage of overall global trade. We actually think that's a good thing. It provides diversification and provides opportunities of investment in other parts of the world to diversify their heavy reliance on the US dollar. So I think it won't ever, one day we won't wake up and say the dollar is no longer the the world reserve currency. It will happen over time to say, wow, if you look at a strategic drawing right in the IMF, it used to be a 98% weight, and now it's a 76% weight, just because of what's going on in the manifestation of global trade.
Yeah, I think that's important. That the focus on are we the reserve currency or not is what spends a lot of time in the media. But yep. I think there's a lot of good reasons why a lot of countries wouldn't want their currency. I don't know if China would want their currency to be the global reserve currency. When you think about how it affects trade and various other factors there. So
absolutely.
And there are pros and cons to having reserve currency status. But yeah, I don't have any other questions. I don't see any others in the chat. So you all had a lot of patience with us, making it till 5:21 Central Time here. So I appreciate you all spending your time with us today. Thank you, Steve, so much for your thoughts.
This is great. Thank you. This is so much fun. I'd love to come back, but thank you everybody for your time, especially like you say, Christian, on Thursday afternoon with nice weather in the greater St. Louis area. So thank you so much for having me.
And yeah, and the other thing I would add too is just I love, so Austin Austin, Jake, and Laura, all of them have way more expertise than I do on the financial planning and tax planning side of things. But I love talking financial markets. So any follow-up questions you have out of this webinar, please give me a call, email me. If you read my commentary, if you're looking for something to put you to sleep at night, you can crack open the commentary. And if it brings up any questions, please reach out. I love talking about these things. So thank you all again for your time, and enjoy the rest of your Thursday evening. Thanks.